Hello and welcome to a VSA Capital video. I'm Ollie O'Donnell and I'm pleased once again to be joined by Simon Clarke, CEO of American Lithium. We're back for the second part of our interview to cover the uranium side of the business and the Macusani project. Simon, welcome back. I hope you aren't too jet lagged from the Future Minerals Forum, but it's good to have you on again.
Yeah, no, I'm fine, Ollie. Thanks for asking, and great to be back. And yeah, Riyadh was very interesting. I think there was 17,000 people a day at that conference. So, I think battery metals are relatively new there, but there's a lot of interest. And clearly on the uranium side, there's a big commitment by a number of the Gulf states to a nuclear future and building reactors. So there is a lot of interest in uranium as well. So it's the first time I'd been there, but I think it was a really good event, and we'll probably look to do it again next year.
Excellent. As we've already talked about, American Lithium is primarily a lithium company, and now you've got two projects where there are published NPVs in the billions of dollars, but you don't get, as research that's gone out today shows, much credit. Even though you've got a few $100 million for market cap, you're relatively undervalued for those, but even less of the value is attributable to your third project, the Macusani project. So perhaps you could give us a bit of an overview on that.
So it's a very large asset. I think what makes Macusani unique is how the uranium is hosted. It's hosted right at surface. It's extremely easy to mine and extremely receptive to acid. You're talking about 10 kilos a ton on the acid side of things. So really low acid consumption, really strong recovery rates, and certainly looking at the prior PEA, the existing PEA on it, we're very comfortable still with the $17 to $18 a pound OPEX. That's largely driven by sulfuric acid, but also factors in taxes and royalties and is an all-encompassing number. So with that, it's an extremely profitable project at $50 a pound, which is what this study was done at. But if you look at $100 a pound today, you would take the 600 million NPV and triple it. So it's the economics are outstanding. It's a large project. It's got a pretty simple flow sheet that's ready to go and to be piloted. So obviously it's hidden right now between our two lithium projects, and it's kind of the third asset there. But it's an asset that it's attracting a lot of attention in its own right, and we've talked several times about moving it out and putting it in its own vehicle, and how do we maximize value for American Lithium and its shareholders. So I think in this environment we're at the point where we're going to look to do that in the coming months here, and again I think that way we will attract a lot more value for it than we currently get with it hidden behind the lithium assets.
And you mentioned that low OPEX, and I guess one of the things that a new PEA would do is update for recent inflation. The uranium price is at $100 a pound, and most companies have been looking for, that are in the development stage, for somewhere between 50 and 70 to incentivize production. So given that inflationary impact, where do you feel is the new sort of incentive price for the industry and for your project?
Well, Ollie, for us, we can make it work at $30 a pound. That I think is the beauty of the asset. It's again, we're very comfortable with the old number at 17 to 18. Yes, I appreciate post-COVID there's been inflation. Obviously, sulfuric acid has gone a lot higher and then come back, or sulfur for the sulfuric acid plant. But I think if you look at what we have done over the last few years, obviously there's been no drilling in recent times, and that's one of the things that we want to do with this asset. But if you look at what we have done, we've shown that the the work that Cameco did. And if you remember, this is a consolidation play. Pre-Fukushima, there were seven companies on the plateau. The Macusani Plateau is the biggest signature, if you like, for uranium in South America. That was actually from a bunch of work the British did post the Falklands to make amends, if you like, or to be seen as better by the South American countries. The British Geological Survey flew South America looking for uranium. Macusani was the biggest signal, so people started to explore it, and then, two major events in uranium, Chernobyl, and so no one wanted anything to do with uranium for 20 years after that. And then in the early 2000s, you had the price of uranium double, and people started getting interested again. And so we ended up with this situation where there were seven companies, the biggest being Cameco. And Cameco had the largest piece of the plateau, or the largest deposit, and they were all working and expanding. And then the next biggest thing that happened was Fukushima, which obviously very bad for the sector in general, but it was the catalyst that allowed Plateau to consolidate the Plateau Energy to consolidate the Macusani Plateau into one large project. And they were lucky before Fukushima. They had a $125 million market cap on a 10 million pound resource. They raised a bunch of money. I think they had about 20 million in the till. Fukushima hit, and everyone sort of left and focused on other things. Cameco kept their asset for a while. It was one of their primary development assets, and but ultimately they pulled back to their producing assets and focused on their core base in what was very tough times for the industry. And so Ted O'Connor was able to join Plateau and bring that piece with him from Cameco. So he went from 10 million pounds to, as I say, 124. So it's a really large asset. The work we've done is building on the work Cameco did. So we now know we can pre-concentrate the head grade with simple scrubbing and screening. We can multiply the head grade by 2.1 times. So if there's a criticism of Macusani, it's the grades are relatively low. The head grade going into the last PA was 300. Now that would be 700. So obviously that has a big impact on the economics. We've also looked at the most efficient way to process. We've done a lot of met work, and our view now is tank leaching is better than heap leaching. It's a smaller footprint. You can do it modularly. You could actually do a phase one where you did 2 million pounds with one set of tanks and then add on. So, when you look at the capex, we actually think the capex of 300 million is very achievable, and in fact maybe less. And the other thing that tank leaching does is it takes the already high recoveries of 88%, which is very high for a heap leach operation, up to 96 to 97. So that alone would give you, you'd take your 6 million pounds a year from the PEA, and that would become 7. So again, there's economic and life of mine benefits from that. And then I think, just updating for current pricing. I mean, we're at 50, which is pretty conservative in the current environment. We don't need higher pricing for sure, but against the backdrop of the price that's now over 100 million. So long-winded commentary of what we have been able to do. But I think, we'll probably look to update PEA initially based on those three elements. And I think we'll see the NPV increase significantly. And I don't think we'll see much, if any, increase in the OPEX side or the CAPEX. I mean, we might see a little bit in OPEX, but again, I think having a higher head grade and the tank will offset a lot of what would otherwise be coming through and maybe be seen as negative to the OPEX. So we're very comfortable with the numbers that are out there. I think the NPV gets a lot bigger. And then the next phase we have a big drill program planned. As you know, we've been waiting on permits in Peru. I think we're very close on that. We have a little bit of a natural hiatus now up there because we're in the middle of the rainy season. In an El Nino year, it's quite challenging. So, we would probably look to start that in the spring, which times well with when we would likely spin the asset out. So, and that would be a big drill program. It would be to reclassify as M&I, but we have over 50 targets from the field work we've done in the last few years. A lot of these satellite deposits we think will join up. I mean, Chemical is drilling south as Plateau is drilling north, and they're about a kilometer away from each other. But if with the scintillometers and all of the field work, you can tell that the uranium mineralization continues between the two. So we'd expect a number of these deposits to coalesce, and we think the resource gets a lot bigger still.
It's perhaps just worth highlighting that some of the key management team that were part of Plateau, you mentioned Ted that put the licenses together, and Lawrence, who designed the flow sheet, are still very much part of American Lithium, moved over with the acquisition a couple of years ago.
Absolutely, and remember, Plateau was originally a uranium-focused company, and and Lawrence set Plateau up. Ted was obviously with Cameco, and ultimately they joined forces post Fukushima and consolidated everything. But Lawrence has been key on the flow sheet as well, and that's been designed by ANSTO. And as you know, we use ANSTO for a lot of our lithium work, but they were first and foremost a uranium, a uranium lab. Very big complex south of Sydney. It's where the Aussies actually make their medical isotopes. They have a reactor there. And they've described Macusani, and it's a relatively unique style of mineralization. It's hexavalent, which you see in other parts of the world, but it's a really young deposit hosted in a volcanic environment, but it wasn't volcanic hosted. It was likely glacial melt deposited. So very benign, sits at surface, and incredibly easy to extract with low amounts of acid, which is the beauty. So the flow sheet is pretty simple. I mean, Cameco in their time had produced yellow cake, and that yellow cake meets most specs. I think there was a little bit of an issue around phosphorus, which we've since cured. I mean, wouldn't have stopped you selling the product. It might have brought the price down a bit. We've since cured that, and so like I say, it's one of those projects that if it hadn't been for COVID and the tail end of Fukushima and the impact on the industry, it would probably already be well through feasibility. It's ready to go, Ollie.
And just to clarify, the change in the head grade, that's from a pre-concentration step that's being brought into the new design.
Yeah, you effectively keep about 85% of the uranium by reducing the mass by about 50% through scrubbing and screening. And as I say, it has the impact of making the head grade go up from the head grade we use in the PEA is about 300 ppm. It would go up to about 700.
Excellent. And this will be, I think, the first uranium mine in Peru. Uranium mining is a bit different from a permitting and legislation perspective. So what has Peru got to do to get themselves on the same level as other jurisdictions, and how do you get the local community comfortable with building a uranium mine?
Well, the local communities are already very comfortable. I mean, obviously Plateau has been on the ground there for 20 years, so the relationships are deep. They're very strong. The communities have wanted these projects, not only the uranium but the lithium, advanced as quickly as possible for many years. They've done their own work lobbying the government to get them advanced. So the support is fine. I mean, if you think about the age of the uranium, I mean, it's not, the issue with it isn't radioactive because it's very young. As you know, you have to uranium becomes an issue as it ages, hundreds of thousands of years and beyond. And often with uranium, it's the sisters to the uranium itself, the other minerals that are normally found with it that can be more problematic. and we just don't have any of those at this deposit. So, we obviously, in terms of Peru, Peru's quite advanced on the nuclear and uranium side, even though they don't have any uranium mining yet. They were an early signatory to the IAEA. IPEN is the watchdog in country under the Ministry of Mines that you deal with. They have a reactor north of Lima, which they use for medical isotopes. So they bring in enriched uranium, which obviously it has the radioactive side to it. So they know how to transport that. So, they're quite far down the road on a lot of fronts. And we obviously have to keep taking readings locally to make sure there isn't any issues with radiation or anything for the communities. And we supply those to the regulators, and there's never any issue. And indeed, once we mine U3O8 and ship it, it's not deemed a radioactive material, it's a toxin. So that all said, we can mine, we can process, we can ship it around the country without any issues. The one piece that we still need to get clearance from is the export side of it, under the IAEA guidelines. And so Plateau actually got the requisite legislation drafted with the help of the US and Canada, who wants to see this developed, obviously, and the Peruvian regulators, and it's ready to go. I mean, it was ready to go 2.5 years ago, but with COVID and changes in government, it's just not made its way through to the point where it's been formalized yet. I mean, we don't see any issues with it. With the new regime being, very pro mining and pro these projects, I would think it would be something we would be able to get implemented pretty quickly over the coming months. Again, it's these things, once we have it in its own vehicle and its own business plan and its own focus, obviously we'll be able to drive them ahead somewhat easier. That's not to say we're not moving things ahead in the American lithium standpoint. It's just, again, you have those two large lithium projects that tend to suck up a lot of time and attention and money.
And talking about the spin out, obviously the equity markets were extremely difficult last year, and whilst we saw the seniors in the uranium space move with the uranium price, the juniors have somewhat lagged, but perhaps that's changed as of last week with the Kazatomprom announcement. We saw a bit of life coming back into the market. So how are you looking at that in the new context?
Well, we've seen we've seen over the last few months. I mean, we did try the market, as you know, in the June time frame, and our timing was particularly bad for that. I think we chose just after Powell started ratcheting up a lot of the talk on interest rates over here, which was generally bad for any risk-off assets, risk-on assets, I should say, and the risk-off trade became a bigger and bigger thing. And so although you had uranium strengthening, I think it was $50 to $60 at the time, and a lot of the majors, as you say, doing well, the new issues market was challenging. So we could have got it away. We decided it wouldn't have got away on the terms that we liked or in the structure we liked, and so we pulled it. And it's funny, very quickly, I'd say literally 3 or 4 months later, we were getting people beating down our door to get control of the asset. And yes, we as uranium's continued to rise and now north of 100, we've obviously seen a lot of the junior projects come back on and get funded. Certainly over here in Canada, there's been a slew of projects that have got funded, and projects that, quite frankly, don't have anywhere near the characteristics or the quality of Macusani. One banker said to me the other day that the market in January for uranium is 50% stronger than it even was in December. So, we really think the timing is right. We're going to learn some of the lessons from the way we tried to do it last time, and our goal would be to spin this out, have it in its own vehicle, because we think, yes, we could sell the project, but we don't think we'll get the value. I mean, we have a number of players who would love us to sell it to them. We're not seeing where we think the value would be. I mean, if you look at developers in the marketplace, typically attracting a 0.7 to 0.8 times NAV right now, and you take our old NAV of 600 million US, which we think is, and that's again off $50 uranium. We think that this thing, done right in its own vehicle, could certainly be north of $250 million in its own right, in its own vehicle. And so we're going to look at the right way to make sure that we get some value for that for American Lithium and its shareholders. Value that we're just not getting right now with it hidden within American Lithium.
Excellent. Well, it sounds like there's quite a lot to look forward to over the coming months, so I'm sure we'll be talking again soon. But thanks very much for your time today, Simon.
Yeah. No, I mean, Ollie, it's great. I mean, we're ready to pilot on it. We're ready to do a big drill program, which I think will reclassify and significantly expand the resource. An updated PA, I think, will be even stronger than the last one, which was very strong. I think once we get all those pieces in place, it can quickly go through feasibility and beyond.
Brilliant. Thanks again, Simon.
Thanks, Ollie. Cheers.